The U.S. exports a lot of natural gas. The first terminal opened in Louisiana in 2016, and since then, it's become the world's third largest natural gas supplier, sending LNG as close as Europe and as far as Japan. Most everyone believes natural gas demand will grow. The question is how fast, how much, and who the players will be. Here's the situation. 157 million tons worth of LNG liquefaction projects are on the drawing board in the U.S. About 90 million tons worth of global projects reached final investment decision in 2019. The problem? Natural gas prices are around $2 MMBTU. For those terminals up and running, no problem. It may even mean more demand from price-conscious buyers. For those waiting to make their final investment decisions, trying to raise capital, or working on long-term contracts, the economics hurt. Export terminal hopefuls need to sign long-term big deals now for a project that will take years to build. If they can't, the world runs the risk of being short the export capacity right when demand needs it the most. And this problem hurts everyone, from producers to exporters to industrials to oil service companies.
Well, Chart Industries recently reported earnings with a record $760 million backlog and confident that some of their big projects will receive that final investment decision. I caught up with Jillian Evanko, the CEO, and asked her about the state of the market.
Most of our customers have been at this for a long period of time, so it's been iterative over the years. And while it's kind of more of a long ball game, in particular on the LNG side of things, so a quarter, 6 months, where an investor might think that matters, it actually, from our situation, doesn't matter because these are 3-4 year projects to construct. So we think it's going to happen, and it's been happening over the last couple of years to get to final investment decision on some of the bigger projects.
Do you think that all the FID in the U.S. gets done?
No.
Well, tell me why.
I think that we've seen kind of the first cycle take longer than what had originally been thought back from 2012, 2014. Some of the first cycle projects are even coming online now. So I think this is going to happen where there's higher confidence projects right now that have more funding for whatever reason, and those projects are going to move forward, and some of the smaller projects that haven't been able to get traditional offtake are going to be the ones that drop off.
How many more waves do you see?
I think there's certainly a third wave, so some of the projects that maybe don't FID in 2020 take a few more years, and we see those come online as that demand kind of increases and catches up to supply. We also are seeing a lot around some of the small-scale LNG projects, some of the global infrastructure build-out. So as that matures, I think we'll see more demand for U.S. supply.
And that's where you kind of get the benefit of low natural gas prices, right? So the lack of the not going projects forward because of $2 natural gas is the bad thing, but the good side is the demand. So what kind of demand increase have you noticed, and how does that play into your business?
So for us, we're more capital equipment suppliers, and we certainly would love all the projects to move forward. And what we're seeing is the low natural gas price is creating a little more parity with other alternative fuels.
Where are you starting to see the demand come up a little bit?
We're starting to see it in trailers, in tanks for bunkering, in regas terminals, in particular in countries like Indonesia and countries like India, certainly where there's a need for power generation, and traditional sources are creating deaths around not clean air. In Beijing is a good example.
Could you talk a little bit about the different types of terminals that will be built later, like in an import side, like the large ones versus the small ones? Like what are we going to see in the future versus today?
Right. So we've actually already seen an evolution from what used to be baseload terminals. There's still some of those, but we're really seeing an evolution to mid-scale in terms of export, and that's around innovation and around becoming more efficient so you can deliver cheaper LNG. We're starting to see the move toward what I would consider more small-scale, micro-scale, where you're serving a remote community and you're able to generate gas locally and serve that community in more of a hub-and-spoke style model. And I think what we're going to see moving forward in the next 7, 10, 12 years, so a much longer kind of time frame, is going to be around being able to take that gas, whether it's imported or created locally, and distribute that into various locations.
Where can you be more productive and be more efficient?
So there's multiple areas you can do that. What we're seeing a little bit is the modular and the standardization side of things. So we offer equipment as well as process technology. Ours is called IPSMR, which is integrated pre-cooled single mixed refrigerant.
Cool. It's catchy.
Accountant came up with that, right? But what's happening is it allows for more efficient production. It allows for less upfront capital cost, and then you're able to, over the course of time, add various different componentry to that process technology, which will continue to drive brownfield sites costs down. And so that's where the future is going, is around how to innovate, whether it's a greenfield or a brownfield site. How do you take what you have and get more gas?
How do you, what does that do in terms of reducing costs? Like how much cost can you bring out as an example for something like that?
So compared to a traditional baseload facility, our process technology on a mid-scale cuts the upfront capital cost by 50%.